Your credit card says 18% APR, and your savings account brags about 4.5% APY, and you've probably thought they're basically the same thing with different letters. They're not. On a $10,000 balance, that difference is $200 actual dollars walking out of your pocket. Here's why the financial system uses two separate acronyms for what sounds like the same idea. Because the math genuinely works differently, and showing the bigger number makes marketing teams very happy. APR stands for annual percentage rate. APY stands for annual percentage yield. Both measure how much you pay or earn on money over a year, but APR calculates interest once at the end of the year like a single lump payment, while APY assumes your interest gets added back into the pile partway through and then earns its own interest. That second round is why APY always shows a higher number than APR when the underlying rate is identical. Banks put APY on savings accounts because bigger numbers look better in ads. They put APR on loans because smaller numbers make borrowing feel cheaper. It's the same game, just flipped depending on whose money is moving where. Let's break the acronyms into plain language. Annual means yearly. Percentage means a slice of the total. Rate is just speed or cost. So APR is the yearly percentage rate, calculated as if all the interest action happens in one shot at year end. If you borrow $1,000 at 10% APR, you owe $100 in interest after 12 months, assuming you never touch the balance. Straightforward multiplication. Yield is where things split off. Yield implies harvest, like crops growing and then feeding the next cycle of crops. APY is the yearly percentage yield, calculated by assuming your interest gets folded back into the starting amount multiple times during the year, usually monthly or daily, and each time it folds in, the new total becomes the base for the next round of interest. So instead of earning interest just on your original $1,000, you earn interest on $1,000 plus whatever interest piled up last month. It's interest stacking on interest, and by December that stack is taller than the simple one-time calculation. Here's how it works mechanically. Imagine you put $1,000 into a savings account advertised at 5% APY. The bank doesn't wait until December 31st to calculate everything. Instead, it divides that 5% into 12 monthly chunks of roughly 0.4167% each month. End of month 1, you earn about $4.17. That gets added to your balance, so now you have $1,004.17. End of month 2, the 0.4167% applies to the new total, not the original 1,000. You earn $4.19 this time. Month 3, the base is even bigger, so you earn $4.21. By the end of the year, you've earned about $51.16 total. If it was simple interest using 5% APR, you'd earn exactly $50, because the math would just be 1,000 times 0.05, done once. The extra $1.16 is the compounding effect, the yield harvesting itself. Now flip it to borrowing. Your credit card lists an 18% APR. The monthly interest rate is 18% divided by 12, which equals 1.5% per month. If you carry a $2,000 balance and make no payments, month 1, you get charged $30 in interest. That $30 gets added to your balance, so now you owe $2,030. Month 2, the 1.5% applies to $2,030, not $2,000, so you get charged $30.45. Month 3, the base is $2,060.45, and the interest charge is $30.91. By the end of the year, you've paid about $393 in interest. If the card calculated it as simple interest using 18% APR once, you'd pay $360. The extra $33 comes from the same stacking effect, except this time it's working against you. The card company doesn't advertise that $33 difference as 19.65% APY, because that's the actual effective rate you're paying after compounding. And why would they highlight the scarier number when regulations only require them to show APR? That's the regulatory twist. In the United States, the Truth in Lending Act requires lenders to disclose APR on credit products, loans, and mortgages. It standardizes comparison shopping because it removes some fees and focuses on the interest rate itself, calculated simply. Meanwhile, the Truth in Savings Act requires banks to show APY on deposit accounts, like savings and certificates of deposit, because it reflects what you'll actually earn when interest compounds. The laws intentionally split the acronyms by product type to help consumers compare apples to apples. A 6% APR mortgage and a 6.17% APY mortgage are the same deal, just described differently depending on which regulation applies. But most people don't know that, so they see two different numbers and assume one product is better. The big misconception is thinking APR and APY are interchangeable labels for the same thing. They're not. APR is the rate before compounding kicks in. APY is the rate after compounding finishes its multiplication trick. If you see an account offering 5% interest, you have to check whether that's APR or APY to know what you're actually getting. Another confusion point, people assume the gap between APR and APY is huge. It's not, unless the interest rate is very high or the compounding happens very frequently. On a 1% rate compounded monthly, APR is 1% and APY is about 1.005%. The difference is 0.005%, which on a $1,000 deposit is 5 cents per year. Hardly life-changing. But on an 18% credit card rate, that gap stretches to about 1.56 percentage points, which on large balances absolutely adds up. There's also a misconception that APY always involves monthly compounding. It doesn't. Some accounts compound daily, which makes the APY slightly higher than monthly compounding at the same rate. Some compound quarterly, which makes it lower. The formula adjusts for compounding frequency. APY equals the quantity 1 plus the rate divided by the number of compounding periods, raised to the power of the number of periods, minus 1. It's exponent math, which is why the numbers grow faster than simple addition. If you see an APY that seems weirdly high compared to the stated interest rate, check the fine print for compounding frequency. Daily compounding on a 5% rate gives you an APY of about 5.127%, while annual compounding gives you exactly 5%, because there's no mid-year stacking. Here's where the simple story breaks: promotional rates and fee structures. Some banks advertise a high APY for the first 3 months, then drop it. The APY they show assumes the high rate lasts all year, which it doesn't, so your actual yield ends up lower. Credit cards sometimes list a purchase APR and a separate cash advance APR, and the cash advance version often compounds daily from the moment you pull money out, no grace period. That makes the effective APY even higher than the stated APR because interest starts accruing immediately and feeding on itself faster. Balance transfer offers might show 0% APR, but if there's a 3% transfer fee, your true cost isn't 0. It's a one-time 3% hit that doesn't show up in the APR math because APR only measures ongoing interest, not upfront fees. Another edge case: simple interest loans. Some auto loans and personal loans use simple interest, meaning they actually charge APR-style math, not compounding. You borrow $10,000 at 6% simple interest for 1 year. You owe $600 in interest, period. No monthly compounding. Those loans will show an APR and it matches your actual cost because there's no compounding gap to create a different APY. Mortgages are trickier because they compound monthly, but the APR includes some closing costs, so the APR might be higher than the note rate even though it's still technically pre-compounding math. It's a hybrid disclosure designed to capture total borrowing cost, not pure interest rate. So here's what you're looking at. APR is the annual interest rate calculated simply, as if everything happens once at year end. APY is the annual rate calculated with compounding, meaning interest stacks on itself throughout the year. APY is always equal to or higher than APR at the same underlying rate, and the gap widens as the rate increases or compounding happens more frequently. Banks use APY on savings accounts to show the most attractive number legally allowed. They use APR on loans because regulations require it, and because it understates the true cost you'll pay after compounding. Neither acronym is a trick, but the system definitely knows which one sounds better in which context, and it uses that knowledge every time you open a statement.